Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. We wish you a great year ahead. Today we're looking at Bitmine Immersion Technologies.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis. For a lot of investors, this name, it conjures up these images of old school Bitcoin mining.
Right, dusty warehouses full of servers.
Exactly. But if that's your mental model, you need a fundamental reset. This company has pulled off one of the biggest strategic pivots in the entire crypto space. They've basically redefined themselves.
Okay, so let's unpack that. I mean, we all knew them as a traditional miner, totally dependent on the crypto cycle. But now the whole thesis is different.
Completely.
It's all about being the world's top Ethereum treasury, a massive scalable holding company. The old Bitcoin business is, what, just a side project now?
Pretty much. It supports the new mission. And, while those mining operations are secondary, the way they run that legacy business, it's actually a key indicator of their discipline.
How so?
They brought in immersion cooling technology. And for anyone who's not familiar, that just means they submerge all their hardware in this special non-conductive fluid.
Okay, for those of us who aren't engineers, what's the big takeaway from that? Why should we care?
Well, it dramatically boosts energy efficiency, for one. It also extends the life of the hardware. And crucially, it just simplifies the physical upkeep.
And that leads to a leaner operation.
Incredibly lean. This is why their entire overhead is run by just 3 full-time employees.
3? That's it.
3. It's staggering capital efficiency for a company this size. It means lower costs, higher potential margins, even as their main focus is shifting.
3 employees managing a multi-billion-dollar operation. I mean, that's a huge statement about where things are heading with automation and focus.
It is.
But let's get to the real story, the core competitive advantage, that moat they're building.
The moat is scale, pure and simple, and it is built 100% on Ethereum. We're talking about the largest publicly traded holder of Ethereum on the planet.
Okay, what are the numbers?
Their current inventory is somewhere between 3.97 million and 4.11 million ETH.
And they're not done. I saw their stated goal is to get to 5% of the total Ethereum supply.
Right. And that kind of scale, it doesn't just make them a large holder. It turns them into this unique crypto treasury vehicle.
This is where we need to look beyond just the numbers on a page.
You have to. That sheer scale isn't just a number. It gives them real influence in the Ethereum ecosystem. When you hold 4 million tokens, you suddenly have a voice in, governance decisions, staking protocols, network upgrades.
So it gives them leverage. It makes them a strategic asset, not just a passive piggy bank.
Precisely. They're positioning themselves to be the highest leverage proxy for Ethereum in the equity markets. It creates these internal tailwinds that smaller players just can't copy.
Let's pivot from that to financial leverage, because this is where the picture gets, well, it gets complicated, but it's fascinating.
It really is.
If you look at the last fiscal year, FY 2025, the headline numbers almost seem contradictory. You've got trailing 12-month revenue of only $6.1 million.
Which is tiny.
But then net income was a staggering $328.16 million.
That enormous disconnect right there, that tells you the entire story of the pivot. The vast majority of that net income is just from the mark-to-market accounting of their ETH.
So as the price of Ethereum went up, they booked those unrealized gains.
And that translated directly into a massive, fully diluted EPS earnings per share of $13.39.
Let's pause on that, because that feels like a potential trap for an investor who's not paying attention. When we say fully diluted EPS, we're talking about earnings as if all potential shares were already issued.
Right.
But more importantly, if that $328 million is mostly paper gains, how much is actual cash they can use? Are those earnings really sustainable?
That is the critical question you have to ask.
Yeah.
I mean, those earnings are completely exposed to the price of Ethereum. If ETH drops, that income goes away fast.
But the balance sheet tells a different story.
The balance sheet is the anchor. The company is, and this is critical, debt-free. Their total crypto and cash holdings are at $13.2 billion. Of that, about $12 billion is in ETH.
So while the income statement is all over the place, tied to mark-to-market, the balance sheet is this massive, debt-free foundation.
Absolutely. That $13.2 billion in assets gives them tremendous stability. And that brings us back to this valuation paradox.
Yeah.
With assets like that and $13 in earnings power, you'd think the stock would be trading much higher.
But it's not. It's trading at, what, 0.80 times book value?
Yeah.
So you're essentially buying the underlying assets, the NAV, at a 20% discount.
Yeah.
Why? Why is the market giving that kind of discount?
It's a mix of things, really. It creates a big risk premium. First, there's just skepticism about how long those high unrealized earnings can last. But the main driver of that discount is the execution risk. It's tied to future dilution, which I know we'll get to.
The fear that they'll have to issue a ton of shares to hit that 5% ETH target.
That's it. The discount is the market saying, we see the assets, but we're worried about how you're going to pay for the growth.
And yet, the PE ratio relative to that current earning power is incredibly low. It's sitting at 2.07.
Yeah, and a number like that usually screams either deep value or huge red flag.
In this case.
I think it suggests deep value just waiting for a catalyst to, de-risk that growth story.
And they've even started a dividend. It's tiny, just a cent per share, but the move itself is symbolic.
It's extremely important. It's a major first for a large-cap crypto firm. It tells you two things. One, the balance sheet is strong enough to support it. And two, they're trying to attract traditional investors who need to see some kind of tangible return.
Okay, so they have the balance sheet. But just sitting on $12 billion in ETH doesn't unlock the value. It has to be put to work.
And that brings us right to the catalyst. This is where they move from being a passive treasury to an active revenue engine.
Maven.
Right. The primary new-term catalyst is the launch of Maven, the Made in America Validator Network, that's scheduled for Q1 2026. This is the whole game. It's the infrastructure they need to generate real income from their ETH.
And the Made in America part of that, that's not just branding, right? That's strategic.
Highly strategic. It signals regulatory stability, security, things that are crucial for attracting large, risk-averse institutional money. Maven is built to their specifications, designed to maximize staking yields and basically transform their ETH from a static asset into a yield-generating machine.
So Maven gives them a real repeatable cash flow stream, something that can insulate them a bit from the pure volatility of ETH's price.
Absolutely. And analysts are already factoring that into their models for next year. And we have two huge dates coming up in January 2026 that will give us a lot more direction.
First is January 9th, the earnings release.
Yep. The consensus is for sustained EPS momentum, building on that incredible $13.39 space.
And the second, which feels like the main event, is January 15th, the annual shareholder meeting.
That's the one. The agenda has the usual director elections, but the big one is the vote to authorize a 50 billion share increase. That vote is everything right now.
And that 50 billion authorization is directly tied to the 5% ETH goal. They need the capital, but the threat of that dilution is what's holding the stock price down.
Exactly. It's a binary event. You either get the scale and the moat, but with near-term volatility, or you don't.
Meanwhile, the macro environment seems pretty helpful. We're seeing expected ETH price rallies, and if rate cuts happen, traditional fixed income looks less attractive.
Pushing capital towards higher yielding plays just like this one. The market really sees this company as the best, highest leverage, institutional-grade way to get massive exposure to Ethereum.
Okay, let's talk price action. This stock has been a wild ride, a spectacular 612% rally.
Followed by a deeply painful 80% drawdown from its high of $161.
So what does the chart tell us now?
That volatility is just part of the deal in this sector, but the technical setup lately has been very constructive. The stock has been consolidating around key support levels in that $27 to $30 range.
Building a base?
It looks like it's forming a strong bullish base. We're seeing higher lows after that big drop, which signals that institutions are stepping in and defending this price.
And this isn't a secret. We are seeing some very big names getting involved.
The institutional conviction is a massive stamp of approval. You've got premier firms like ARK Invest, Founders Fund, Pantera, Galax Digital, all showing significant accumulation.
A cluster buy.
When you see a cluster buy like that, it's a powerful signal. It tells you there's high confidence in that 5% target and the Maven monetization plan. ARK, for instance, has been actively buying the dips.
And the trading volume is huge. It's one of the most heavily traded U.S. stocks with daily volume near $980 million. That's not just institutions.
Note, that liquidity reflects huge global retail interest, too. We've seen significant inflows from Korean retail investors, which is always interesting.
Right, that can be a leading indicator for broader market sentiment.
It can. So you've got this combination of fundamentals, institutional backing, and a stabilizing technical chart that makes the picture pretty compelling.
We can't ignore the risks. No investment here is a sure thing, and we have to spend some real time on the bear case. What's the biggest, most immediate risk?
Dilution. without a doubt.
Yeah.
The January 15th shareholder vote to authorize 50 billion new shares is a massive overhang.
It's necessary for their big strategic goal.
But it puts immediate pressure on the value of every single existing share.
So, given the high institutional backing, you mentioned ARK, Pantera, who really want them to hit that 5% target, do you think this vote passes easily? Or will smaller shareholders fight back against that kind of dilution?
That is the core anxiety. I mean, since institutions like ARK have been buying on the premise of achieving that scale, it suggests they will support it. They bought the vision. The vision requires capital.
But it's the retail investors who feel that pain most directly.
Exactly. So that creates friction.
Yeah.
The expectation is that the institutional support will probably carry the vote, but the uncertainty is going to create some intense volatility.
And the second major risk, which we've touched on, is just volatility itself. An 80% drop is a painful memory for anyone who held through it.
And that volatility is a direct result of being leveraged to Ethereum. If ETH has a steep pullback, this stock is going to feel it even more. And that doesn't just hurt the share price, it hits the source of their massive reported income.
So how do you mitigate these risks if you're a long-term investor looking past January?
Well, the mitigation factors are strong. First, the market has already priced a huge chunk of this risk in. That 20% discount to NAV. That's the market telling you it's worried. You're getting paid to take that risk.
And the second part?
The second is that pristine, debt-free balance sheet. It's a giant safety net. They are not dependent on credit markets to maintain their treasury. That gives them immense resilience against market shocks. They can ride out the volatility without facing a liquidity crisis.
Right, no margin calls.
None. They have the capital, they're building the revenue stream with Miavan, and the structure is solid. The only thing missing is the market fully buying into this transition from, a cyclical miner to a scalable crypto treasury.
So here's the final thought then. This company is becoming the premier, highly leveraged way to get Ethereum exposure, and it's managed with incredible efficiency. It's trading at a clear discount, and we have a very specific calendar of events.
The Miavan launch, the January 9th earnings.
And that defining January 15th shareholder vote, all of which could unlock that hidden value.
The structure is definitely set for an asymmetric reward, as long as the market can stomach the dilution needed for scale. You should absolutely keep those dates, January 9th and January 15th, top of mind. The implications of them hitting that 5% ETH target are just immense. It would fundamentally change their entire financial structure.
Make sure you subscribe, like, and comment to stay updated on all our future stock analysis talks.